Just checking again if you can hear my sound. And tonight I am your session leader. My name's Henry. I have over 10 years of teaching and marketing experience, including being a professional marketer at the CPA, independent contractor for CPA, and also in the past I've been a UFE prep marketer for PwC, and I've mentored several UFE, CFE national honor rolls. Okay, so it seems like now everybody can hear. Okay, excellent. So now I can go on. I do apologize, but thank you all for helping me calibrate the sound as we were going. And so tonight's session, we're going to talk about ASPE from a comprehensive review standpoint. And I'm going to touch upon a few of the most tested topics, or at least the more complex ones that have been usually seen and have been tested in the past. And the first part when I go on is I want to actually talk about how the handbook is laid out. There's a standard structure involved related to the purpose and scope, the definitions, recognition, subsequent measurement, presentation, and disclosure. And I just want to pull up the handbook for all of you to see so that you can sort of get an idea of what I'm talking about. So here you can see the handbook. And, all of you should have the Kenosha reference version. And what you should see is also, there's the exam reference version. I still have some people who say they can't hear anything. I just want to still get another double check to see that my audio is okay and you can hear me very clearly on what I'm talking about. I'm just going to pause for a little bit while you guys can kind of take a look and see. Or I'm just going to wait for a bit of the comments to come through. Okay, so to me, I'm hearing everybody saying I have audio. So those that have some sound issues, this is probably specific to you only. Okay, so you guys can see the handbook, right? And I'm just going to open the accounting specific section. Okay, Sumit, thank you. Audio is perfect now. And I want to show you, as I'm sifting through the handbook, I'm just going to go through accounting standards. And, the initial slides that you guys do have, the content is all posted in the webinar folder. Okay, thank you, guys. I'm just going to use one section, revenue, and I'm going to open that section up. And I want you to just pay attention to the headings that are here. And, one of the key skills that I want to teach you first is how to use the handbook. And it doesn't, there's a whole bunch of pages. The language is actually quite complex because it is what practitioners actually use in the real world. So getting a good understanding of, first let's get an understanding of the framework or the architecture of the handbook. And that will help you, especially in an exam situation. I mean, how many of you have wrote the exams that you're going through? And you're like, oh crap, I can't figure out what to do here, and you're sitting in the exam, either using the search function or trying to look through the sections and find what you're looking for, and are kind of struggling. Like, anybody want to sort of anybody can relate to that? But I kind of want to make that job a little bit easier for you to understand. And the first thing I want to do is for you to recognize, in general, specific items are dealt with in the numbers 3000 to 3870. And they actually go from assets to liabilities to revenue, and then expenses, and then they have these other items, right? So I just kind of want to first lay out that specific framework for you so that if you're looking for something specific to assets, you're probably going to start somewhere from the top up here, and then you're going to start scrolling down. So that's the first thing I want you to pay attention to. The next thing is within each standard, there is a standardized section of how it goes about. It goes from purpose and scope, and I also want you to pay attention. There's bold, and then there's not bold. And then sometimes as you're reading, there's italicized. And so I want you to pay attention to also the formatting. So when you're looking at the bold sections, these are the main sections or headings of the handbook. And if you actually look at it, if I go to contingencies, it's the same general sections: purpose, definition, Then there's other things related to measurement and certainty, accounting treatment, but for the most part, it starts with purpose, definition, then it'll be recognition, and then there's presentation and then disclosure. So the first two, you'll always have purpose, definition, presentation, and then disclosure, wrapping the end, right? The middle part is specific to the actual section. So in revenue, we deal with two things generally, which is initial recognition, right? Everybody always talks about revenue recognition, but there's actually other aspects of revenue. For example, presentation and disclosure. There's examples when you're dealing with if you whether or not you should record commissions on a gross basis or a net basis, and that's actually an issue related to the presentation of revenue, and that has nothing to do with revenue recognition. So I want you guys to kind of recognize that it's not, get away from the templates and thinking about just because you see revenue doesn't mean the issue is about recognition. Sometimes it's on recognition, sometimes it's on measurement, and sometimes it's on presentation. So it's really actually important to identify what the actual issue is, but the way that you would go about it is looking at these bold sections of the handbook. So there's the bold section of the handbook. The next part I want you to take a look at is you see these areas where it's unbolded, and these are the more important details or guidance that is actually presented to you. So, if you're going to start reading the handbook part of your technical review for studying for the exams, it's not like you're going to read this top down. You kind of have to recognize it's like a choose your own adventure, and you're going to look at first identifying, let's say when you're reading a case, to know what section you're dealing with, or what the problem is, and if it has something to do with recognition, then you're going to have to go through and click the recognition section, and then you're going to find the specific element related to revenue recognition, for example, and what criteria need to be met, and that's when you start drilling into actually the italicized part. So the criteria is actually aligned with the italicized part. Now in this webinar, I've given you a little bit of the notes to kind of help you guide you through some of the common scenarios and the framework of how the handbook is written for these sections. But I just kind of wanted to give a overall groundwork for you to see. And when we start doing some cases together today, addressing some of the issues, you sort of see how actually it's all compiled, and it's actually quite a worthwhile exercise to learn to do this, okay? Okay, so going back to the handbook. So we have, if you remember, purpose and scope, definition. Now here's the first part that I kind of want you to pay attention. It may be labeled differently, but it starts with recognition. So, using an example for fixed assets, if I've acquired a machinery equipment, the first thing I need to do is record it. And they're going to tell you, I can recognize some things related to cost, the transportation costs, or maybe like, let's say, for example, interest costs or whatever it is that I need that is part of that equipment, and that is to be capitalized to the equipment. And that's defined in recognition. The first time, the initial cost, that's what's being recognized. Then afterwards, let's say after 1 year, my year end is December 31st, 2018. After 1 year, 2019, I need to record something. That thing that I need to record is amortization, right? And so that amortization or depreciation that I need to record, that's called subsequent measurement. That's what I need to do after initial recognition has been recorded. And then there's presentation. So what do I need to do in terms of recording it? It needs to be shown as a long-term asset. It also needs to be shown in the notes. So that's examples of how presentation and disclosure come into play into the handbook. So in a general framework, the way that I want you to think about the handbook is purpose and scope and definitions. That's going to talk about in that issue, when you recognize there's some problem, you don't know what it is, you're going to look at this part first to tell you, am I in the right section to use the guidance available? Is something capital or expense? Well, then you're going to look at definitions, and it's going to tell you what PP&E is. And then there's recognition and measurement. So when I first receive that machinery, what should I be recording on the financial statements? Then after 1 year has passed, what other things do I need to recognize after that year has passed? So hopefully when you're reading a case, you're going to look for that issue, and then you want to be able to clearly articulate what they're testing you on. So if I use revenue as an example, the issue is around when should revenue be recognized, or what about revenue should be recognized. So that's an example of how you define or state what the issue is. Some people will just write, how should this be recorded? Or the issue is revenue recognition. And, like, that's generally not specific enough. And today I hope to help show some of the ways writing goes about so you can see what that looks like. Okay, so what are the most important 7 ASPE topics? There's revenue recognition, inventories, intangible assets, capital assets, related party transactions, asset retirement obligations, and leases. So the first thing is, when you're looking at revenue recognition, you want, and again, we're talking about now the middle portion of the revenue section, revenue 3400. So the first is to understand the type of transaction you're dealing with. And the advice I want to share with you is, sometimes in a case, you may have multiple streams of revenue, and the way you need to discuss your revenue recognition is based on the revenue streams. So if you have product sales, service performance, those are 2 different types of revenue recognition, right? So, but it's important to recognize, is it goods? Is it services? And then you will talk about how performance is going to be achieved. And I'm going to give you guys an acronym. It's a Henry secret to share with you, so you can think about, when you're dealing with ASPE specifically, what type of way you want to begin your have your discussion go through it. So that's the next thing. So Kalpana says, and financial instruments. Financial instruments are commonly tested, but it's not in every case. Based on the history and the past that we've looked at, that I've looked at specifically, the topics that I've listed out are the very common ones that you'll see. And financial instruments only come here and there. Most of the time it'll be, let's say, even compound instruments, but that's not as common, if you were to say, versus the topics that I've listed out. Okay, so the next is, you have services, which are not tangible. Possession and legal title aren't important. It's really revenues looked at on an expense recovery basis within a specific period. Goods and services, it is possible to have revenue linked to both goods and services together. Fixed cost for both. This is known as multiple deliverables, or bundled of different products. Sometimes when you guys purchase some products, there's a service component and a product component. Like, if you bought a air conditioner and you want that installed, you have to hire a technician to come install it for you. So that technician also may actually have that specific model of air conditioner you want, and they'll say, okay, so if you buy this air conditioner and have it installed by us, we will, it might be slightly cheaper, right? But rather than if you were to buy it separately and then you were to hire another contractor to install it, you can see there's 2 type of deliverables here. There's a goods portion, which is the actual air conditioner, the product, and then there's the service portion of the contractor, individual technician who's come to install it. So that is what is an example called as multiple deliverables. And I want you to make sure that you can think about that and see that, because revenue recognition is sometimes not as simple as I've just shipped out a product and I can have that revenue recognized, or I've performed the service, like I've seen a patient here, and the patient, I've done my services to help the patient, and the patient is gone, and recognized revenue is sometimes not that simple. So when it comes to revenue recognition, understand the consideration you're achieving. So what is the details of the transaction? Like, let's say service for cash or product for cash. The other is, there's possibly something related to goods or service being exchanged, a barter type exchange. So for example, maybe I'm part of a community center that relies on sponsorship. So I can offer space or real estate in the community center for $5,000, but at the same time I can also exchange maybe sponsorship. Maybe this company who wants to sponsor, put sponsorship in my community center, sponsorship space, rent that space for $10,000, and in return, instead of paying me $10,000, I will, because I'm in the business of printing and publishing pamphlets and flyers and business cards, I will in return give you a certain amount of pamphlets, flyers, and business cards for you to print, and I've exchanged that one service for sort of another type of product or service, right? And that's an example of a barter. Then you have commercial substance. So does it have commercial value? Really, the commercial substance, the way I want you to think about it, is there a dollar exchange, dollar exchange? And is it a legitimate transaction? And then is it arm's length? So arm's length is like, is it related, right? So, or is it independent? So these are some things that you want to think about in terms of when there is a exchange that has happened, look at the consideration being received. So problem areas, some things to watch out for are unusual return policy, loose credit policies, bill and hold arrangement, customer acceptance, ongoing or additional services, continued involvement. And I'm not going to cover these specific sections all in detail because there's different revenue recognition situations that have happened, but I kind of just want to point you through to, I want to kind of teach you to fish instead of me always fishing for you, but at the same time just showing you what that would look like. So in terms of guidance to help you, I want you to take a look at, again, just going back to the handbook, and I'm pulling up the section here. And so you can see, right in this section right here, generally delivery is not considered to occur unless the product has been delivered to the customer's place of business or another site specified by the customer. Some of the aspects of the revenue arrangement an entity would consider in determining if delivery has occurred or services have been rendered as follows: bill and hold arrangement, customer acceptance of products, layaway sales arrangement, non-refundable fee arrangements, licensing and similar fee arrangements. And sometimes, there's things called cancelable sales arrangements, right of return. And, if you scroll through it, it kind of just these are the general common scenarios that you would be faced with. So just be careful of these common situations that the exam writers would put you in, and be very clear about that. And I just want, again, we'll share with you a framework to recognize these things. And usually the framework that gets in that framework, the question that gets challenged most is, has performance been achieved? So, just going back to the PowerPoint. So how do you measure a transaction? How to recognize revenue? And I've just taken this straight from the handbook. In 3400 paragraph 05, in a transaction involving the sale of goods, performance shall be regarded as having been achieved when the following conditions have been fulfilled. The seller of the goods has transferred to the buyer the significant risks and rewards of ownership, in that all significant acts have been completed and the seller retains no continuing managerial involvement in or effective control of the goods transferred to a degree usually associated with ownership. And reasonable assurance exists regarding the measurement of the consideration that will be derived from the sale of goods and the extent to which goods may be returned. And then in paragraph 6, in the case of rendering of services and long-term contracts, performance shall be determined using either the percentage of completion method or the completed contract method, whichever relates the revenue to the work accomplished. Such performance shall be regarded as having been achieved when reasonable assurance exists regarding the measurement of the consideration that will be derived from rendering the service or performing the long-term contract. So you'll see below, I actually wrote down a tip. And the tip, or the acronym, is RCMP. We all live in Canada. We know what RCMP is, but in this aspect, I actually will use RCMP from an accountant's perspective. It's kind of lame and boring, but bear with me. So the first thing to think about is actually when you recognize there's a potential problem with how they are recognizing revenue, as an example. First recognize, is it a goods type? Is it a service type? Or maybe it's a combination type. In combination type, which is called multiple deliverables, you would have to address that separately. That's the first part. But let's say you've categorized and known it's goods type. So then you have to see and ask yourself, following the RCMP acronym, have risks and rewards transferred? So if I delivered the goods, I have no idea what to, I don't have to deal with the product anymore. It's given to the customer. It's no longer mine. The risks have been given. The rewards have been given to the customer. It's no longer mine. Collectability is assured. That means I have very good certainty I will be getting this money. Like otherwise I wouldn't have made the sale, right? So collectability is assured. Measurability is achieved. That what that means is, if I'm selling you a product for $100, I've given you, it's measurable. I know how much it's going to be. Sometimes, people will give certain goods. Goods, it doesn't really apply here, but services, you don't know what the appropriate measurement would be. And that's when you actually go through that discussion of percentage of completion or completed contract, okay? Then you have performance has been achieved. And performance has been achieved is where we go back to the handbook section where we're talking about bill and hold arrangements, contract, sorry, let me just pull up the PowerPoint slide. Go back to bill and hold arrangement, customer acceptance of products, layaway sales arrangements. So these are examples where you've got to be a little bit more careful of how you discuss the performance. And that's when we'll go through some of the writing techniques here to deal with that revenue recognition related to performance. So when you're writing in your case specific scenario, risk and rewards, you're going to write, have they been transferred? And then you're going to use case information to describe if it has been transferred. Then you're talking about collectability. Well, if they don't have case information to point that out, then you can say there's no concern or case information given to question the collectability. And then measurability is, they should give you some dollar amount or something along those lines, and that's when you can start assessing whether or not that has been met. And then performance, that's where the case information usually will twist you a little bit, and that's what they're really testing, and that's really what the issue is, right? So going on to the next part of the discussion. So other issues within revenue recognition, again, all described here, straight from the handbook, guys. So percentage completion, this is really when it comes to if the company can reasonably estimate its progress towards the performance obligation, then it can recognize revenue over time instead of the end. And the very big tip I want to put out, because when I mark professionally the papers that I see, some of the responses that people do is they go into a very detailed discussion talking about percentage of completion. Mehmet, I'm glad you love it. RCMP. The key takeaway I want you to see is it can be recognized over time. It's actually over time and over multiple years, right? Otherwise, like if you're selling something and you're recognizing over a few months, there's generally less of a concern related to the cutoff of the revenue, right? So it's when there's a period or a duration of when revenue should be recognized, that's what you have to be a little bit more careful about if it's going to span over multiple years. So, something like a construction project, right? That's a very good example of that. Now, ASPE specific only, completed contract method. Completed contract method provides for reporting revenue reflecting true final results instead of estimates throughout the period. Often used when estimates are not reliable, and that's the very big part. If you can't have any idea of any way of measuring some way that progress is being made, and you can't estimate how the work is going to happen, then you've got to use the completed contract method. It means you're just going to hold out recognizing revenue all the way until it actually can be recognized, right? Like until you've actually been able to perform or do the service, or that project has been complete. So it's not a great method given that it does not account for interim revenues, as such reflects a transaction over one single act. And this is more also from like a general analyst point of view. Nobody likes a sudden pop in things, right? They like things generally even, or just some way of getting an update. As a small note, right, for those of you who are like working with a boss, and when you do work, what I didn't like when I used to manage in a corporate world was when people used to do work, they would do, if they had this habit of doing work and then suddenly giving you that final result, and I look at this final result, let's say the deadline is May 18th, and then they give me the final thing by May 16th, and I look at it, I'm like, this is like nowhere near what we were expecting. That's like completed contract, right? Like it just suddenly you get a whole blop of surprise, and you're like, you don't even know how to handle or deal with it. Whereas percentage completion is sort of like you're giving progress updates along the way. If you went off track at the beginning, so usually like a good tip I can share with you is like when you get given a task and you know there's a certain deadline to it, the first thing you want to do is do a little bit of it and then give it to your manager or your supervisor to look at and get some feedback. See, are you heading in the right direction? Are you filling it in the right way? And then afterwards, then you start replicating and building on top of it. And that way, there's no surprises when the deadline has approached, right? So this is an example of comparing revenue percentage of completion versus completed contract. When it comes to an analyst's point of view, they're going to suddenly see some huge chunk of revenue just recognized. They're like, what in the world is this, right? It's going to flag too many questions. So an example problem. Chelsea Clinton signs a 1-year contract with Fancy Gym Inc. The terms of the contract are that Chelsea is required to pay a non-refundable initiation fee of $300 plus membership fees of $83.33 per month. Fancy Gym determines that on average their member renews their annual membership twice before canceling. How much revenue can be recognized by Fancy Gym Inc. in the first year? So I'll give you guys about 2 minutes to kind of first let's figure out. Let's use actually RCMP. So in your chat, just write RCMP. Is the risk? When is the risk transferred? Risk and rewards transferred. What is the measurement? Is there issues with collectability? And then performance. And I'd like to know how you would determine the revenue recognition amount. So I'll give you guys 2 minutes for that. All right, so let's work this out, just kind of very high level. There's 2 streams of revenue that we have, right? So we have the $300 non-refundable initiation fee, and then we have the $83.33 per month. If we multiply by 12, pretty much, let's just round that up to $1,000 a year. So Amit says he would recognize $1,300 in the first year. Anybody else? Okay, now we've got, and then Sarav Preet says 83, so it's $1,000, and then 300 divided by 24 times 12, 150, 11, 49. There are two sources. Yep, 300 non-refundable. Therefore, Johnny Janoy says there are two sources. 300 is non-refundable, therefore it can be recognized right away. As for the monthly, it is recognized after each month because only then risk has been transferred. It is measurable, and assuming it is collectible at the end of each month, performance has been achieved at the end of each month because she is access to the gym. Akil says risks and rewards. The risks are transferred at the end of second year. Collectible, yes, the amount is collected. Measurement, okay, excellent usage of the framework. Eugenia says 300 non-refundable probably can be recognized right away. Okay, so this is good. There's actually a variety of ways that you could have recognized revenue for this. Also, 300 is not large in comparison with the annual monthly fees, so should not be spread over 12 months. Actually, that's a very, very valid point, Eugenia. Eugenia? Samit says risks and rewards transfer in case services when services are performed, collectibilities for 12 months revenue. So excellent. No, this is all very good. You can make a very valid case to recognize the 300 since it's non-refundable, recognize upon signing, right? This is the key part to put down upon signing. And then the other part is like, could you spread it over a couple of months? Perhaps. What if my year ended is December 31st and I've signed this contract in November? And if I sign it in November, I only have performed 2 months of services. So yeah, I will recognize that monthly stream of 83.33 per month, but that membership, maybe $300 might be considered too aggressive. And so there's the thing I want you to take away. The first thing I want you to take away is that sometimes there is no right answer to the situation. It's all based on the case information that are given in front of you and how well you use it. And when we are writing these cases in an exam, the big takeaway for you to take away is that it's not about the answer. They have you write cases because it's all about how you show your work. They're testing your professional judgment. And so it's all about how you articulate or background what makes sense. So if you're able to construct an analysis that makes sense, so for example, if you argue that $300 should be recognized right away since it's non-refundable, valid point. If you say it's too aggressive, and most of the time it's over 2 years, so maybe you want to amortize it over 2 years, very acceptable. And maybe the contract is for 1 year, so then you amortize the $300 over 1 year. Again, very acceptable. So the key thing is I want you to recognize that it's all about the case information and the professional judgment that you have put together. Yeah, Eugenia, very, very good point. So, again, it's all about how you craft your discussion and demonstrate your professional judgment. It's not about the answer. If, a lot of times before, a lot of my mentees, before they go through training with me, let's say, or, as I give them feedback on their cases, they think the answer is just like what they get. But really, it's all about how they've gone through the discussion. So Janoy James says, since there are two streams, would this be considered as a single AO or as two AOs? The construction of the AOs, I have to be candid with you, it all depends on generally how they want to orient it. In this example, it's kind of small to put it as two, right? But it can be one, it can be two. It really depends, and that's just something generally you might not want to worry too much about. It's a nice to know, not a need to know. Okay, so the next topic is inventory. So why is inventory so important? Inventories are assets kept by a company that's ready for sale. Inventory provides an opportunity for a business to sell something to a client, and they must keep relevant stock to meet demand, and then they must manage costs associated with keeping inventory. Costs are measured using cost of goods plus cost of goods acquired equals cost of goods available for sale. How do you recognize revenue? So as part of ASPE 3031-07 provides guidance which states that inventories are assets. They're held for sale in the ordinary course of business, in the process of production for sale, or in the form of materials or supplies to be consumed in the production process in the rendering of services. Again, so it's actually really important for you to think about. if you are in the real estate industry, for most people, if I'm investing in real estate here and there, I don't sell it often, right? Or change often, then it's actually just that would be like a capital asset for me. And then when I sell it, it's like a capital gain, or it's an investment, right? But what if I'm in the real estate industry and I actually am in the business of managing properties, holding it, exchanging it on a very frequent basis? Those properties or those houses, let's say I have like a ton of houses that I just sell and flip here and there, that is actually inventory. So it depends on the type of business that you are in and whether or not it meets those definitions. So that's why definition of inventory is really important. I'll even use another example. If you are in the business in an ostrich farm, for example, maybe ostriches lay eggs, right? So maybe you just sell eggs. So are those ostriches? Actually, I'll use chickens since everybody knows chickens. Chickens, if they lay eggs, are those chickens? Those eggs? That's for sure like inventory, right? But are those chickens who lay eggs that you're keeping there? Are they? But those chickens, they can be used for meat, right? So is it a asset, or is it a capital asset, or is it an inventory? And it's really important that you can attach the definitions in the case to make sure you can distinguish what type of inventory it is. So it's not that simple. I just wanted, most people, when they are writing an exam under a panic mode, they see something like this and they're like, oh, right away it's inventory. But sometimes it could be fixed assets. Okay, so how to account for risks and rewards transferred and include the cost of inventory. So goods in transit, freight on board shipping, legal title is buyer, possession shipping company, control, risks and rewards, yes. Inventory is recognized by the buyer. What if it's a consignment sale? The legal title is to the seller or owner of the inventory. Possession is possession, so the retailer owns the inventory. Control, risks and rewards, there's nothing. Inventory is recognized by the seller or owner of inventory. So if I have inventory held at, let's say I sell vitamins to Whole Foods, and Whole Foods arrangement is that unless your product sells, then you can't then it sells, it's yours. But if I can't sell this, I'm returning this back to you. That's really almost a consignment arrangement. It depends, Eugenia. I have a different philosophy when it comes to that. If we look at the lifespan of a chicken, they do last quite long. It just, it depends on how it's being used from initial birth to actually development. Anyways, then there's sale with buyback. So legal title, buyer, and then possession is the buyer, control. The risks and rewards they don't have, so the inventory is recognized by the retailer. Sale, where you can estimate returns. So if you can estimate the returns, so the legal title, buyer, possession is the buyer, control, risks and rewards is yes, and therefore the inventory is recognized by the buyer. What about if it's sales with delayed payment terms? The legal title is with the retailer, possession is the buyer, so control. The risk in other words, risk and rewards is yes, and therefore the inventory is recognized by the buyer. So just really important to recognize when inventory is, just because it's not physically with you, it doesn't mean that it's commonly with the buyer. Sometimes it's still with the owner, right? And then there's a purchase agreement or commitment. Legal title is the retailer, possession is the retailer, is there controller? No, so the inventory is recognized by the retailer. Measurement of inventory. The most common thing that people think about is, when I recognize an inventory situation, the first thing they'll jump to their head is always, is it on lower cost or net realizable value? But actually the spectrum or the breadth of issues that you deal with inventory can be quite large. And one of them is ownership, who actually owns the title of the inventory. The second is now the measurement. What can you include in inventory? And so this includes all costs, conversion costs, and other costs incurred in bringing the inventories to the present location condition. And that includes transit costs, handling costs, and direct costs of acquisition, which includes non-recoverable tax and duties. And another way I want you to think about it is inventory is more than just the raw materials. There's sometimes conversion costs involved, like work in process and finished goods. And most of the time, when people see, let's say, they're in the business of selling a certain product, but they don't have inventory on hand, instead it's always expense, people think, inventory, just the materials amount should be capitalized, but actually it's materials plus a certain amount of variable costs and also a percentage or a certain allocation of manufacturing overhead, whether it be direct or indirect labor and things along those lines. So are purchase discounts included? Yes. Vendor rebates? Yes, if it's probable and reasonably estimated. And then borrowing costs. If interest is capitalized as policy and the amount that is capitalized in the current period must be disclosed. What costs are always excluded from inventory? Selling expenses like commissions, storage costs, and then general and administrative expenses. Instead, these are called period costs. Happens within a specific period. So for example, if you have rent, you're renting a warehouse to store this inventory, that's a general, period cost. That's an example of period cost. So, if that's separated out from general admin, but, just use that as an example. And then there's basket purchase. So applies relative to sales value to each proportion based on fair value to each item. So if you're buying a specific list of a basket of things, and there's a fair value attached to each of them, you're going to do that percentage weighting across it, and then you're going to apply that value across the individual basis. Let's say you've got it at a cheaper cost, but you still got to apply the weighting, the same retail fair value weighting on it. Okay, so cost formulas, specific identification used for one-off items. Usually, this is for larger type inventory that you might have. Then you have weighted average cost. You can choose that between weighted average cost or FIFO, first in, first out. LIFO, last in, first out, is not permitted. So just kind of ignore that in case it does happen. It's a situation that's not common in Canada. So, but if it does show up in a scenario, then just be aware of that. Cost measurement. This is about the valuation of inventory. This is what most people think about when they see inventory issues, which is cost must be the lower of cost or net realizable value. And that net realizable value, less cost to sell, is measurement techniques. You can use the direct method or the allowance method. And there's some exceptions. The exceptions is sales is assured or there's an active market for the product, or cost of disposal can be estimated. So an example problem, during 2016, Giant Office Chairs purchased a new stock of inventory chairs with an updated roller design. The manufacturer sold them to Giant for $60,000 because it was discontinuing this line of chairs. There were 1,000 chairs in stock, 500 which were sold by the end of the year. After the year end, Giant put the rest on sale for 30% off. What is the new value of inventory that should be recorded on the books, assuming all chairs are expected to sell using the sale price in 2017? So I'll give you guys 2 minutes to work through that question, and let's see what we have. And just like that, it's like I'm in a room of accountants. Great with the math, right? So it's $60,000 for the inventory divided by 1,000 units, which is $60 per chair. Then you have 500 sold, right? Then you have the 30,000 left at 70% less cost to sell, which is 21,000, which is excellent. So you guys know when it when it comes to numbers, I definitely don't have to doubt you guys. So the next topic we're going to talk about here is intangible assets and goodwill. Types of intangibles and goodwill. Intangibles, they're identifiable, results from contractual or legal rights. They're separable, it lacks physical substance, they're not monetary, possible for things like AR, and they provide economical benefits. Goodwill, asset, so I use that term loosely here. It's representing the future economic benefit airing from other assets purchased in a business combination. Excess of purchase price that does not relate to the fair value consideration received versus transfer. Think of it as like a plug, right? So when you're buying a business, you pay a premium price, but if you actually take the fair value of the assets in the net assets of the business, let's say the net assets of the business is $100,000, but the person paid 120 for whatever reason. Just that premium, that additional premium of $20,000 is called goodwill. It's kind of like that plug. It's that perception of it's much higher and they had to overpay that $20,000 to get the deal, right? Recognition and measurement. Measured at cost when probable that the entity will receive expected future economic benefits. So again, going back to the framework of the handbook, this initial measurement would be for you to determine and figure, or recognition is to determine and figure out what the initial cost would be when you receive it, right? So 30,000. Exceptions, this based on case fact triggers. Watch out for delayed payments on purchase of intangibles. Can you really recognize it? And then intangible assets purchased for shares. Look for fair value of shares as the cost. And if you give up non-monetary assets, exchange of say AR, accounts receivable, cost of intangible as fair value of assets given up, or fair values received, whichever is more reliable. So when it becomes now non-monetary in terms of that consideration exchange, things become a little bit more complex, and now you've got to start determining which is the more reliable fair value item. Okay. If purchased as part of a business combination, watch out to make sure it's identifiable in nature, right? So usually you'll start with, instead of just a general 20,000 plug, there will be other case information to describe. Maybe they have some special literary work and agreement involved that can do something that actually can have a attached value to it that you allocate to it. So if anybody has ever done a purchase acquisition, it's called the purchase price variance, and you're kind of allocating it across. You're allocating what was paid across various identifiable assets. Okay. Rather than just lumping it as goodwill. So the next thing is internally generated intangible assets. So think of, has the assets been created to generate cash flows? What costs are capitalized? The rules provide for a choice in ASPE for recognizing costs as internally generated intangible assets when certain criteria is met, and recognize all assets as expenses. Research and development. So the first thing you'll see is in research space, if you're in the research phase, or when you're reading the case, you have to recognize which component of it they're talking about. Think about knowing whether it's in the research phase or in the development phase. So here, research stage, this is what you would expense. You have new information or knowledge, finding new methods, alternatives, products, designing new ideas, evaluating new possibilities. Nothing is really tangible yet, right? So that's research, and that's really an expense. Pretty common sense, right? Then you have development, so capital. So you're constructing prototypes and models. In the modern world, we have something called the minimum viable product. It's been a very, in the last few years, it's been a very popularized term, the MVP. Then there's technological innovations, constructing pilot projects and assets, and then new alternatives. And then the development phase criteria, when you're going through, these are the case criteria you want to use in your handbook, your case response discussion when you're addressing intangible assets in that development phase. Is it technically feasible uh, in terms of completing the intangible asset? Is the entity's intention to complete it for use or for sale? They're not going to hold on to it. They want to use it and sell, right? The ability to use or sell it, availability of technical, financial, and other resources needed to complete it or use it, and then the way in which the future economic benefits will be generated, the ability to reliably measure the costs associated with and attributed to the intangible asset during development. And the best way I can kind of think of it is, let's say, you have a whole bunch of programmers coming together who are going to create and write software. While they're coming together to write software, is the technical feasibility of completing the intangible asset? Well, the software that they're developing is kind of intangible, right? They're just writing a whole bunch of lines of code, and that line of code is supposed to create some sort of function to do what that software is supposed to do. So maybe if they've run into something where, let's say, a couple of years ago, Elon Musk wanted to create autopilot for cars, right? Like self-driving capabilities. At that time, maybe that technical feasibility was not there. But now, over time, after enough research and demonstration, you can see he's even had a recent press conference to even show that that feasibility has been largely accomplished, right? The intention to complete it or use for sale, yeah, there's complete big intention that he wants to make sure that all of the cars in Tesla have that autopilot capability, ability to use it or sell it. Yeah, he can definitely sell the code or the patent or the lines or the software involved in doing it, and then availability of technical, financial, and other resources needed to complete it. So this one is usually the tough part. Technical means do you have the right expertise or people involved in dealing with it. Financial, usually some people might run out of financial resources, and if you don't have enough financial resources, that project is questionable. Like, it's no longer like 70% is not good enough, right? Like, it's not going to be complete, and that might be an indication. Just because you don't have financial funding to complete it, it might fail, right? So that's generally a dangerous trigger to be aware of. Then the way in which the future economic benefits will be generated, and then the ability to reliably measure the cost. I mean, you're paying salaries, right, to develop the code, and server costs to hold the code, and the other servers to do the mechanical calculations, and so on and so forth, right? So Saurav, what about software upgradation costs, expense, or capitalized? If you're upgrading software and you're paying for it, then yeah, that is part of that capitalization, right? So here, can you please explain the way in which the future economics will be generated? So going back to my example on the autopilot, the way in which the future economics benefits will be generated means, as an example, when it's completed, there is future economic benefits. You can sell or you can attach that module onto other cars, right? Like if you ever go on or log on to Tesla, right? They can add on, you can get the chance to add on the feature to have autopilot onto the car as part of it, right? So that's a future economic benefit that you can sell already, though the capability right now is not there, or maybe it's because of legislation, which is part of it, right? But you like that development, the resources put into that development is actually quite usable, but there's other barriers in place. But you can sell that package in the car as part of it. So that's an example of a future economic benefit that will be generated. It's very clear what that benefit is. Does that make sense, Eugenia? Okay, so measurement after acquisition for ASPE is cost model. So if you are acquiring it, then it's your general cost and accumulated amortization. And again, I just want to pull open the handbook for all of you to take a look at this. And the advice tip, I guess, I want to make sure you are using is you're using the exam reference version, because that's what you get in the exam. And at the same time, if you go through it, you'll also have, I want you to make sure you are familiar with this, because you want to get practice doing this in a non-time constrained environment. If you're writing the exam, the last thing you want to do is go through scrambling, figuring out what this is. So internal control, intangible assets, and then you have the development phase right here, right? And then right here, boom, you have all of the criteria that you need to use and discuss for it. What Eugenia asked, what impact it has on capitalization, what to watch for. Joanna asks, can we say in the case that since the 6 criteria for don't have been met, intangibles should be recognized in financial statements? So the fact of, Eugenia asks, so the fact of benefit. Rajesh says, upgradation required for every, how can it be capitalized? If upgrade extends useful life, or yeah, exactly. So Eugenia's like my teaching assistant tonight, and like saying, so if the upgrade, you're paying for a software upgrade, if it is specifically to improve or increase the quality or speed or something, right? That's capitalized. If it's just something that's like routine maintenance, fixing a bug or something along those lines, that's an expense, right? So Joanna, the question you're asking is a little bit ambiguous, and I'll kind of explain it from a long perspective. The first thing I want you to pay attention to is if an entity can demonstrate, so this is very important for you guys to write, it's not an or, it's an all of the following. So it's important for you to actually work through each individual piece of the criteria and demonstrate it on the case. Again, going back to what I talked about at the beginning of the session, it's all about how you demonstrate your professional judgment. It's not about the answer. They don't care if it's capitalized or research or expense, sorry. It's how you've worked through your professional judgment. In this case, the guidance, what's guiding you, and then what information are you using to attach to that guidance to determine whether or not you should capitalize or expense it. If you just simply say all 6 criteria are met, capitalize, you're not going to get the necessary evaluation from the professional markers. Wei He asks, regarding research versus development, could you explain what's the difference between research with finding alternatives and development and the new alternatives? Actually, Wei, could you kind of explain what you mean by that? I'm not too sure about your example, but I kind of talk about from the research perspective. If you're sort of just testing the waters, considering various alternatives, seeing, do I want to go here? I need to gather more information, research from customers, talk about things. That's an expense, right? Like you're just researching. I'm not sure where you got the develop alternatives. So if you can expand a little bit more from what you were talking about from the development side. New alternatives, what I meant by that is like, let's say oil barrels versus like solar. You're kind of finding new alternatives to have an output in energy. That's a different alternative, right? That's a different way of doing. Or maybe you have supplements instead of oral supplements. You're now creating via a pill format. You're doing it now via a liquid format. So that's an example of new alternatives. Does that make sense, Wei? Okay, so impairment. You're comparing the carrying amount of the asset's fair value using discounted cash flows. No requirement for period testing. So here you're actually looking for, if we look through the handbook, I'm just going to pull that up again. We're only looking for those triggers for impairment. Again, we're going to look at here's where you would go through the impairment of long-lived assets section. But in general, we're looking for the trigger versus like IFRS. There has to be a generally annual assessment versus ASPE. We're only going to be questioning or concerned when there's something coming up that makes us question it. So that's why there's no requirement for period testing. And usually like a case will give you that trigger, right? Goodwill specific items, watch out for both positive goodwill, excess paid above identifiable assets, and negative goodwill, bargain purchase. So most of the time when you think of an acquisition, sometimes most people think of, oh, they paid a premium, but sometimes you actually have sold a company at a discount, and that's actually a bargain purchase. And that is recognized right away and treated as a gain in net income under ASPE. Impairment under ASPE is required when events or changes in circumstances indicate. So test the theory. So you're comparing the carrying amount, which is what's recorded on your balance sheet, to the fair value. And that fair value in general terms is defined by the discounted cash flows. And if we go back to the criteria, right, guys, in the capital assets, all of these like future economic benefits, if we go back to the like these development phase criteria, you have to have a certain amount like future economic benefits. You have to have that like cash flow to be able to determine whether or not it is actually working, right? So that's why it's important to know it's you can separately consider it. So and that's why you can compare it to the carrying value, and the case will generally give you that information to make that determination or calculation of a discounted cash flow. There's no reversal allowed in goodwill impairment or intangible impairment under ASPE. So if the trigger is large and that trigger and that capital cash flow has been done, discounted cash flow has been done, there is no reversal of it. So that's another key point to take away. Eugenia asks, is there integration with tax for R&D? Yeah, there is. This is beyond the scope of the what we're talking about tonight, but that's for SHRED, right? Scientific research and educational development. That's part of a separate thing that you would talk about in terms of, when it comes to a case. Okay, so the example problem, Good Food Biscuits is a producer of organic and gluten-free biscuits. The company was established 4 years ago when the founder purchased the trademark. I gotta say, you guys are fully engaged in this session tonight. Good Food Health, and its patented biscuits recipes. And Good Food discovered that there was a large marker for this type of food and began offering the products exclusively through their website, www.goodfood.com. All product sales are through the company's internally developed website. Good Food is wondering which parts of their business can be deemed an asset. So let's use this case information. Let's see. I'll give you guys 2 minutes to kind of like solve this. What are the separately identifiable components of this business that you can see right now? Okay, so you guys pretty much nailed it. I will say, if you take a look at the example problem, probably what would you say is the main intangible asset? What's really the core or key success factor to the business? And Janoi has it patent. It's actually yes, patent recipe website. Well, actually, patented biscuit recipe is actually together. So actually, the first part is for sure the patented biscuit recipes. That's actually what's driving the sales, right? The recipes, and then the name trademark Good Food Health. Maybe if it's sold under, what if it was, yeah, Jonah's got it, the recipe. So what if the recipes were sold under a different brand? Do you think there would be a uh, a value related to that trademark? Potentially, right? That trademark has been, if depending on how long it's been there. In this case, it's been there for 4 years. So that Good Food Health trademark has a reputation of 4 years, right? So just think of it like if you never worked on it, if you were never employed for a long time, and suddenly you have a job, you don't have really any like track record. You don't have any background, so that value is not there. So you can actually see there's actually a value to this trademark because over 4 years the patented biscuit recipe has earned its reputation, right? So that's why there's now a potential value for it. And then the next thing is the website. What if the website didn't help generate sales? Then that might not be through it. But right now, all product sales are going through the company's internal generated and developed website. So this is those. What I was saying is really important. The patented biscuit recipes, that's actually the core of the business. So that for sure has a value to it. And then when it comes to the trademark, it's not just because the trademark is there. If we work through the criteria, there's a reputation that has been established on those four years ago, right? So there's a proven track record for it. So people recognize the brand, they know, and they will just go through it, right? And then the last is if it says all of the product sales are going through the website, that's why the website has value. Just because if the producers, the founder built a website, that website and they've paid somebody to do it, that may not have any value to it, but because the sales are being funneled or distributed through the website, that is why there's a value attached to it and you can capitalize it. Hopefully it's all about the case information and how it's used that makes the difference. This is really key. I really want you to be able to recognize that, guys. Okay, so the next topic we're going to talk about is property, plant, and equipment. Is a tangible fixed capital or plant asset, all mean the same thing. Machinery held for use in the production of goods, used for more than one accounting period. If it's not inventory, it's tangible. It's not about how long it lasts, guys. It's about how long it plans to be used. Capitalized in cost, and then componentization is important based on separate useful lives. This is actually more a bigger thing when it comes to IFRS, and then it's subject to depreciation. Cost elements. So when we talk about issues related to fixed assets, most people jump straight to, again, thinking about a fixed asset impairment, or maybe there's a problem with the amortization, but there's actually another issue that can come out of this, which is the cost elements. What items can you capitalize into these fixed assets? So costs include all expenses needed to acquire the asset, bring it to location, and make it ready for use. And the handbook gives you that specific detail or that guidance around it. And I'm just going to pull that up for you to take a look. And so costs, acquisition costs or development over time. Click that section. Costs include direct construction, development, material. Again, because they're developing and they're putting it into to making it ready. Capitalization of carrying costs ceases when it has been substantially completed. And then here, on a general, finished fixed asset, you have cost of an item is, you include brokers commission. It can include architectural design, engineering fees, all this stuff. Again, these are defined in detail, so it's not like you have to memorize it and recall it for verbatim, but you just need to know it enough so you can recognize in the case if something like that is given, you know where to jump to and you know where to go right away. And again, going back to the framework of the handbook, this is now we're talking, it's not about the recognition, right? It's about measurement. It's like, it's not just the finished good of the the fixed asset. It's what other costs can you add on to it to make it part of the fixed asset. So that's why it's measurement, right? Like measurement, we're trying to figure out the dollar value to record down. Um, here I've already talked about those size costs when it's complete or producing ready to use. Any net items practices are included in assets costs. Self-constructed assets cannot include indirect costs. Only costs that are allowed are direct costs. So it has to be very clear about what's being involved to those items, and it's like direct labor. It's not indirect labor. Like an accountant's salary that was part in corporate office where it was for the warehouse, you can't allocate those costs into the fixed asset. It makes common sense, right? Measurement should be a cost. If you buy a combination of fixed assets, you allocate based on the relative fair value. Again, the relative fair value means if you buy a couple of assets and there's a fair value measure on them, let's say by evaluator, or maybe it's on an actively traded market, then you know what those fair value is. But maybe you bought it at a significant discount. You're just taking now the fair value of the products, the fixed asset that you did, and you're weighting it, and then you're just applying that weight onto the basket price that you bought your assets at. Make sure this commercial substance test is met. Significant change in the future expected cash flow in the company. The way you can also think of PP&E is it should generally be revenue recognition, revenue producing. Like if you have a residential building and you are renting it out, it's a revenue producing property, right? Okay, measurement after acquisition for ASPE, cost minus accumulated amortization. So a subsequent measurement, guys. And then capital versus expense, increase in the economic benefits. So other things that you're adding on, maybe after a couple of years, you've added some new components. Does that increase in the future economic benefits? And then day servicing that does not add to future benefit does not get capitalized, right? So one of the discussions is capitalized versus expense. Capitalization of borrowing costs. It's avoidable in nature, would not be incurred unless you use it for a specific person. If not avoidable, then it is not capitalized. Think indirect line of credit. If it's not avoidable. And then borrowing costs under IFRS requires capitalization of borrowing costs, whereas ASPE you get a choice. The key thing to take away is you can get a choice to capitalize borrowing costs, but that has to be stated in the notes. Capitalization period is the time when interest is capitalized. Starts capitalization when expenditures have been made, activities that are necessary to get ready for intended use or sale are in progress. Borrowing costs are being incurred. Avoidable costs. Steps to capitalize include finding the expenses associated with qualifying assets, determining borrow rate, it's avoidable, and determining capitalization rate, percentage used for this asset, and then you calculate the borrowing cost. Example problem here, Tesla Co. incurred $270,000 in costs for roofing work on its factory, $260,000 to replace the previous roof, and $10,000 to repair and replace a few shingles on the garage portion of the roof. The original roof that was there for 15 years prior to the repair, the CEO of Tesla Co., Ellie Misk, is turning to you for advice on how to account for the costs associated for the roof repair. Take maybe 2 minutes. What would you capitalize and what would you expense, if anything? So the most common one people will say is capitalize 260 and then expense the 10. Can you argue that the 260 could be also expensed? Um, I mean, it is replacing it. The original roof was there for 15 years prior to the repair. Maybe you're just replacing the roof. How do you, maybe it's not extending the useful life? That's an assumption, Akil. It doesn't say. Yeah. So yeah, most people will say 260 is to capitalize, 10 is to expense. But I'm just playing with you guys. Most of the case, I'll just say, um, just be aware of sometimes, you can adjust the case facts, but not adjust, but if it's not clear like this, you've got to be able to interpret the gray area. The obvious is obviously, you say you want, if it's replacing, it's 260,000. But what if the material is not as good, right? So you don't know. Um, Genoa, maybe. Maybe. Okay, so related party transaction. Related party transaction triggers can include company management, members of immediate family, companies, or individuals. And this is where it's actually really important when you're marking up your case to design a system to mark things up. And today we'll kind of take up a case really quickly on that. And one of the things I kind of want to demonstrate to you guys and see is that it's really important that, for example, for me, I will circle dates, I will circle roles, and I also circle people that are involved, and and it's important to understand the relationship and how they're connected, because sometimes related party transactions may be involved and you don't even know it. And this is how some ways that most candidates actually miss a significant discussion point, and in their analysis, the professional marketing guides are expecting you to identify and integrate it in the analysis, but a lot of people may not do it. So it's just something to pay attention to, okay? So standard rules under ASPE, related party transactions must be remeasured at the carrying amount of the underlying assets or services that were exchanged, typically the current book value. Use this decision guide to define, is the decision in the normal course of operations? Yes. Is the transaction non-monetary exchange or transfer of non-monetary asset? Yes. So is the transaction an exchange of products or property held for sale in the normal course of business? Yes. Then carrying amount. If it's no, does the transaction have commercial substance? Yes. Or no, yes, then it's exchange amount, or if it's no, then it's carrying amount. Is the ownership interest in the item substantive? Yes. Is the amount of exchange supported by independent evidence? Yes. Is the we're just working down a decision tree. And so is the transaction a non-monetary exchange or transfer of a non-monetary asset? No. Carrying amount. And then if it's the other one, then no carrying amount. And again, I just want to pull open the handbook for you guys to take a look at. Related party transaction. So this was the diagram that we were just going through, and this actually is very, very helpful for you to save and think about when it comes to working out whether or not which in your analysis to determine. So the issue is usually when it comes to related party transaction, the issue is which is the appropriate measure to be recording at: fair value, exchange, or carrying amount, right? So this is the decision tree that you are going to work out on. Okay. Asset retirement obligation. Dismantling and restoration costs. In some industries, a company acquires and uses its long-lived assets and take on the obligation until the asset is eventually retired and stops generating cash flow for the company. The requirement is deemed an asset retirement obligation. Think about it. So let's say I'm in the industry of oil, and I have oil tanks, or I'm in the garbage industry and I have a garbage site, or I'm in a mining industry and I'm like mining minerals and resources. I'm digging a hole in the ground and I'm creating a mess, right? And when I'm creating this mess, eventually I've gotten the permits, let's say, to do it, but eventually over time, once I've extracted what I need to do or whatever, um, the expectation, there's usually a guide in terms of legislation to say you've got to clean this up. And there's a future cost involved, and that's what a asset retirement obligation is. And that's why, again, going back to your case, the way to trigger it is to look at what the industry is. Again, part of your markup on your case question is to mark up what is being triggered, right? Or what the industry is. So the recognition ASPE requires costs associated with the liability to be recognized using legal obligations. Think of court case, legal bylaw, and so on. That measurement, cost estimates, and any changes are capitalized in the asset account. Included in the asset balance, subsequent credit is made in the ARO. The way, think of it, it's debit asset, credit liability, and that's what you're going to need to amortize or accrete over time. Subsequent credit is made to the ARO liability, and costs are not incurred for several years. This is an expectation, think estimate, and such measured using present value of the future costs. The last topic we're going to talk about is leases. Leases are rentals of property and possibly include a transfer of assets for book purposes. Monica asks, can you further explain what a change of substantive ownership means or looks like? If I were to sell a car to my sibling, would you consider that a change in substantive ownership? And if I was still paying for it, no, right? It's still my car. I'm still paying for it. But if I have changed the car and I've also have him, change the ownership, and I've also had him pay for the remaining payments, then there is a change in substantive ownership. Does that make sense, Monica? You have to use the case information to derive what that change of substantive ownership would look like. Okay, so basic definitions. Going back to leases, leases are rentals, right? And first, when you think of leases, there's two categories. Are you the lessee or are you the lessor? And if you're the lessee, that means you're the one paying the rent. If you're the lessor, you're the one renting, getting the rental revenue. And so the lessee treatment, the obvious one is to talk about the issue whether or not it's operating versus capital lease. And so for this, you're going to recognize the lease when all risks and rewards and benefits are normally transferred to the lessee if and only one of these need to be met. There's a reasonable assurance. There's a bargain purchase option at the end. 75% of the economic life is under lease, and 90% of the present value of minimum lease payment is included in the payment. So it's one of these three. And I will speak from a professional marketer perspective. In this example, underwriting it, I would still follow and write through these three criteria. Even though one needs to be met, I would still do that. This is, again, we're as candidates are writing to pass the exams and everything, we're trying to prove to the marker we're very capable potential CPAs. And by that means if by you putting these three criteria down, even though you need to meet only one, you're proving that you're able to demonstrate your professional judgment because you're looking at things beyond just the one thing, okay? Lessor treatment, it's operating or sales type lease or direct financing lease. So sales type includes profit, direct financing does not. You're just including income or interest and And the other part that is actually unique that people don't get enough experience seeing is called the sale leaseback transaction. It's a form of financing and it's not really an unusual transaction. Let's say I have a building and that building is mine. I have now sold the building, but I want to also lease it now. So I'm just paying so I've sold the building for however much it's worth, but I also leased it back. I'm leasing it now from the person who I sold it from. And so that's an example of a sale leaseback transaction. And so here's an example problem. Suncorp entered into a 4-year non-cancelable lease with Toyota. Inc. for a vehicle. The present value of lease payment is $44,500 after the inception of the lease. Suncorp has learned that the life of the vehicle is expected to be 12 years and the fair value was $50,000. Title does not transfer and the vehicle can be resold to another user without modification to be used for a different purpose. How should Sun treat this lease? And I'll give you guys 2 minutes, and I'd like to show me your work about how you derived your conclusion or your treatment. So, Saurav Preet put together a great discussion there. So 45,000. The present value of the lease payments, 44,500, is less than 90% of the total value. The lease term is not 75%, and there's no bargain purchase option. Everybody's saying it's operating lease. So, as a multiple choice question, that is correct. The 89% and 90%, if you argued it was a capital lease because the number is so close, that's also quite fair too. And so, this really depends on the case information. Obviously, I am playing with you guys in terms of limiting the amount of case information you have and all that stuff. So this is really where it's starting to get important to understand that bigger picture. So on a technical perspective, that number is very correct, right? Like what you're working through, the analysis, operating lease, conclusion, you won't be wrong for that. But don't be surprised if there's a potential that even though it's so, but 89% versus 90% is quite close, and so sometimes it's not about being that rigid, and you have to use the case information to derive sort of how maybe it can be potentially a capital lease too. Okay. Yeah, Eugenia, excellent. There you go. You need to know the intention. Yeah, that's all. That's wicked. Okay, so in the webinar material, there was also some. Yeah, that's right. There was also some a case question. So I want to give us a chance to go through this together, and it's really important for us again. If you're not going through the CFE, it's still like all of you are still faced with writing cases at the current moment. And so it's important to understand the context of where we're writing these cases. And it's really good to learn how to extract information out of it. So again, I'm just going to mark up the case as we go. And as I'm marking up the case, it's good to be able to see sort of how I do it, right? And maybe you guys can pick up some things that I'm going through to do. So I'm going to start right here. So I'm actually just labeling some paragraphs right now. Okay, and then I'm going to start reading. So, as I was labeling the paragraphs, I'm able to sort of see what information I'm dealing with. There's a lot of things I'm doing, and I'm just trying to navigate along the way as I'm talking. So you can sort of get an idea of what I'm talking about. So 2014 new CA. I'm a little nervous about my taxes. I care about these emotional words because there's some things I have to address. But we're talking today specifically about financial reporting, ASPE. So I'm not really going to go too much in detail on the other assessment opportunities or technical competencies. I just am going to talk about financial reporting. If you take a look at my numbers and let me know this tax bills, my contract buddies. Here, so there's one assessment opportunity here. AO number 1, tax bill. My contract, I'm starting to have been bragging about their corporations and how they've been saving taxes. I'm starting to wonder if it's time for me to do something. So it's not really a assessment opportunity, but it's something that wants to be looked at. So investigation, response on business taxation structure. Oops. You tell me what my total tax bill is if I've been incorporated. There you go. So there it is. So now you know what the assessment opportunity is. So most people would have highlighted, should I do a corporation? But that's actually not the requirement, right? AO. Well, actually, I'm just going to build upon that note. Number 2, tax if incorporated and response on taxation structure. I wonder if it would be really saving money in taxes. Say that my family I need in this year. Here's my balance sheet and income statement. Balance sheet and income statement for Exhibit 1, as well as some other tax notes. And specifically this, as well as some tax stuff and other notes about my business. Okay. So you can see I've actually summarized this paragraph. In the second paragraph, I was wondering if you could help me with some decisions I need to make with the growth. I need to get my own workshop. My wife is tired of me having all my equipment in the garage, having weighed a few options. Maybe you can help me out. So in Exhibit 3. you visit, you go back to the office, and your manager happens to stop by. Heard you were just talking to Carl. He spoke to me well because his business is expanding. He's exploring bigger projects, which will allow him, require him to be bonded by insurance. And with that insurance, they want ASPE. So here's our other assessment opportunity. This is what we're going to work on today. Requires reviewed financial statements for ASPE. Let me know what accounting. His wife does all the bookkeeping, has no formal training. Big picture story of expansion and growth. And AO number 4, financial reporting. So a couple of things, and dissecting the first page for you guys to see. And from that first page, I already know exactly directionally, here's what I want to do. And I just kind of want to write this big story out for you to sort of see how this all plays out. Big story, page 1, paragraph 4, talks about recent expansion and new projects, which therefore leads to AO number 3. Whoops. Management accounting expansion plans. Oops. AO number 1 and 2, tax, which is tax bill, and corporate business structure, and then AO number 4, financial reporting to support the expansion plans. So this is really important. Most of the time, when people write their cases, they actually just look for these requirements. This is not your fault because you've been instructed incorrectly and, in my opinion, badly. And what I mean by bad instruction is that they say, oh, let's look for the assessment opportunities or the requireds, and then you're going to look for issues, and you're just going to go through the case, and you're going to solve those things. What I teach a lot of my mentees is actually to start from a calmer perspective compared to everybody else. And everybody else is scrambling, figuring things out. Actually, a lot of my mentees, they go through very calm and cool when it comes to approaching their cases, because I ask them to first find the big story. And the big story is every case has a reason why it has been written. Otherwise, there's nothing to write about, right? So in this story, because Carl is looking to expand, in that expansion, he is going to consider a few expansion options. We don't know what they are yet, but let it be. And through those figuring out that expansion options, he now needs to be bonded, and the insurance company wants financial ASPE related financial statements. So you can see that there's a connection between it. A lot of people, if you can start getting the connection of the cases, then it really drives everything. It makes everything so much easier to do when you need to locate the issues. And as you start reading on, you're going to see issues, and on those issues, you're just categorizing to where it goes, right? And then your tax bill and your business structure. So Eugenia asks, is this a typical day 3 case? Yeah, it is. It's quite representative of a day 3 case. And so it's really important. So you can see how, because of the expansion plans, they need to be bonded, so that's why you do financial reporting. And then because of the expansion, he also wants to know more about his tax liability and see is there opportunity to plan his taxes in a tax efficient way. It's all built around because he's expanding and growing, and this is really important to see that connection. Every case has these type of stories in place, and those assessment opportunities are the obstacles. So if you solve these assessment opportunities or the technical competencies, you theoretically will solve and support what he needs to do to support that big picture, what he needs to do to expand, right? So right now we don't know what we need to solve, but we know we need to do something. So we read the case, and I'm going to go through some of these issues relatively quickly. I will attach the solution so you can go through, but I kind of want to work through one of these suggestions that we went through today. So today, we covered revenue recognition, inventories, intangibles, capital assets, and leases. Maybe in about 15 minutes, I'll try to do revenue recognition and leases in the time that we have, and then again, you'll have the solution, and you'll see the solution is different in terms of the way that it's written. And I want to also talk about solution is not written in the CPA way. These are older cases that are been written by the CPA Canada, and so it is representative of day 3. We're still working on the same things, but at the end of the day, the case writing mechanics and the skills are always the same. Okay, so here we see an exhibit 1 talking about inventory, PP&E. So I'm going to look at inventory, and inventory here. The inventory represents construction progress for house. The selling price is $300,000. Going to underline that. Customers paid a deposit and my usual signing agreement, so I'm just going to underline that. The house will be 2 stories and it's going to cost me $225 to build. So far, I've excavated the land and poured the foundation for $100,000. So there's a revenue recognition issue here. Revenue rec issue. And also land excavation. Okay. So here note 2 is related to PP&E. I'm not going to cover PP&E on this chat because it's just again, you'll have the solution for that, right? But you can see how I can see that right away, right? Note 2 PP&E. I can pretty much tell you there's an issue related to PP&E here. Sales talks about sales. Receive 20% of sales up front and remainder when the house is complete. So this is a part of case information that I want to use. Case information that I want to use is here. Note 2 is bank interest charge, nothing to do with revenue. So again, I'm just looking for information right now for we're going to talk about leases and revenue. Okay. During the year, replace excavation equipment for $10K. That's related to PP&E. I'm not going to deal with that today. New truck purchase, again, all PP&E, PP&E, PP&E. Here, this is related. So here, other information collected from Carl is related to tax, right? So all of this is related to the tax requirement. So nothing, as a quick write down. Again, normally as I'm reading the case, I'd be underlining, highlighting, making notes on the margins. And so, okay, here, financing options. I need a new building. I could either build one myself or lease one. I think it would give me about $450K of material and building. I would need to finance the cost, given a spent on the land. If I lease the building, I will not need to borrow. I have listed my options below. Option 1, build it myself. Option 2, build it myself. Option 3, lease it. So okay, so here's the lease issue that we're going to talk about. And it is smaller than what I want and is at the end of however, I would not need to borrow. So I'm highlighting, underlining this because this is a qualitative point that I'm going to use in my discussion actually. Maybe he has a tolerance for not wanting to borrow. It seems quite common. He's talking about he doesn't want to borrow money anyways. I would need to sign a 20-year lease at $33,000 per year. The lease payment would be due at the beginning of each month. I would have the option to buy it out at the end of the lease for $1. The building is already old, so it lasts only another 5 years after the period ends. The owner has a recent appraisal that indicates the building has a value of $425,000. So, I'm gonna write here lease issue capital is operating. Okay, so assuming I've gone through and read the case in detail, this is what I would go about doing, right? I'm just doing sections of the case based on that component of what we're going to focus on. So the next thing we're going to do, I'm actually going to try to open a Word document and write this with you guys. Actually, it doesn't seem like it's working with the Word document. Just give me a second, guys. Yeah, Eugenia, that's a very good question. Um, okay, so the first thing you guys can see this, right? So going back to the question, Eugenia, you're quite solid. So the first thing I'll look at here is, I kind of didn't highlight that point. So I can obtain financing from the remaining 10% of the borrower, which is for 6%. So this person can get 6% is what the interest rate you would use as the borrowing rate. Or there's actually a slight secret to this, which was if you figure this part out, you have to use an Excel formula, which is figuring out the implicit rate, and the implicit rate is about 4%. With the present value minimum lease payment calculation is about 4%. So that's why this building value was important to have written down. Okay, so let's talk about the issue. Let me bear with me. Okay, so case information. Oops. The case information could lease a building somewhat suitable for the needs. Carl, issue. Carl, it didn't copy. Okay. Anyway, I'm just going to type it out. Carl may enter into a long-term lease for a new building. The issue is whether or not the lease is capital versus operating under ASPE. Analysis. Copy from the handbook. So the guidance says here. Okay, and then Carl has the option to buy out the building and of the end of the lease for $1. This is met because it is considered a bargain purchase. Second criteria. Carl expects the building to last only 5 years past term of the lease. Lease term is 20 years or 80% of the remaining life. So this is substantially all of the economic benefits is being derived from this property. This is met. Last, lessor. Carl's incremental borrowing rate is 6%, and the implicit rate of the lease is 4.81%. They're using the lower rate, the minimum lease payments with a net present value of 425K, which is 100% of the current value. So, small comment. You can see really actually how quickly this is being done. And if you can't figure it out, you already gotten 2 of the criteria done. And if you use 6%, there's actually still not that much of a problem. And you may not get the same answer, but you're already addressing the issue. So, conclusion: since all criterion is met when we only need 1, this would be classified as a capital lease if this was the option Carl were to choose, and therefore the impact on the statements would be to increase fixed assets and equivalent liability. After would have to do amortization and impact and accretion below. Done. Okay, so you can see this was done pretty quickly, written very fast, and nothing too unusual about it, right? So, the issue, analysis, talking about the case, taking the guidance, applying the guidance using case information. This is straight from the case. I just remember it, right, after reading it, and I can take that down. And then I make a conclusion to say whether or not this is met or not met. This is met, So hopefully, seeing this live example is able to help you sort of get an idea of what that expectation is to achieve the depth. Most people, when they're writing their response, they don't put adequate response. They just sort of write some things of what they think off the top of their head, and that's pretty much it. And you can see this didn't really take very long. It took a long time because my setup was just a little bit rough and tough here, but just kind of giving you that idea, okay? And just quickly, I'll kind of touch upon the revenue example. So if we look at revenues, sales 1, typically records sales when cash is received. Oh, missed writing that up. So, we have a revenue recognition issue. And 20% of sales up front and remainder when the house is complete and ownership has been transferred. So this is what he gets when he receives cash, and the remaining when the house is complete and ownership is transferred. So if we were to write this issue, Carl currently records revenue on a cash basis. This is not in compliance with ASPE, which requires accrual basis. The issue is determining the appropriate revenue recognition for a house building and how much is to be recorded. And then I'm going to copy from the handbook. Analysis, copy from the handbook. The transfer of significant risk and rewards of ownership only occurs at the transfer of the building title to the buyer. The measurement of the consideration is known at the time of sale. However, given this is a long-term contract, additional guidance needs to be considered. I forgot, so measurement, collectability is not in doubt. Remember RCMP, guys? So now I've got to talk about long-term contract, right? In the case of, because it's a project over more than one period of time, again, just copy from the handbook. And then since Carl is in the business of building and selling homes, this would constitute performing a long-term contract. Our options are the percentage method or completed contract. So taking the handbook sections, again, paragraph 17 and 18, I'm just taking what's, the formatting is not very good, but you kind of, let me see. Okay, so this formatting is a little bit better. Given that Carl should be able to reasonably determine the extent of his progress towards completion of the house, the most appropriate method is percentage of completion. The percentage completed of all houses or projects in progress at year end would need to be estimated. And then in this case, the selling price so each selling price is $300. It costs $225 to build. Since he records 20% of the upfront and the remaining house is completion on the buyer, so then we kind of need to work out these numbers because we're given it. So in this case, 300K on sale, 20% on initial deposit, cash received. Uh, he he records 60K. However, it should be recorded based on um, based on total. Oops, based on total work involved to date or progress. So we know estimated costs is 225K. And the cost to build the foundation was 100K. Therefore, the house is about 44% done in terms of cost, which therefore translates to 133,333. So, an additional 73,333 would need to be recorded. Additionally, you guys remember there was the $100,000 for recorded as inventory for excavation. And so again, I'm just taking the guidance and therefore the 100K related to the foundation is associated with 133,333 in recognized revenue and should be removed from inventory and expenses. Recommended conclusion. Revenue should be recognized on percentage completion on a per project basis. Based on the example above, revenue would be increased by 73,333 and AR would be 73,333. The inventory would be written off as excavation expense of 100K and inventory would decrease by 100. Okay, done. So, I've written a very long form under pressure in front of all you guys, the answer of what it would look like under that time constraint. And you can see I went very elaborative on it, but you can see it's like generally quite straightforward if you go through and do this in detail. So Saravpreet asks, can you get this document file? You do get the solution, so you can evaluate the solution through this. I'm not sure if you if you want this file, I can save it and attach it afterwards. But you can see this is generally quite quick. So this was a 90-minute case, and it took me about 5 minutes to write each of these issues. And if I went through all of the issues, 60 minutes across the board, 30 minutes to plan it, 60 minutes to write it. Again, could have just worked through it. It's just like bam, 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 and work it throughout. So this is sort of the pace that you may want to. You may not do it as fast as me, but you want to be able to see and see what it's like to kind of write under that pressure. If you're sort of like very casually looking things up, not knowing where to go, this is gonna really kill your time, right? So that's just something for you to get that idea, okay? I'm also gonna save this marked up version just for you to take a look at, and you can debrief afterwards. No, Buzz, I actually have like I have two screens, so I was just pasting it from another screen to another. Normally, you have a different context. You guys work under Surpass, so you want to just get used to the orientation and the layout that you have in Surpass, but it's still, you can see some of the formatting that I had didn't work out, and so I just kind of like went back to the handbook standard and did it, and you can see how quickly I was still able to gather it. And it just comes with practice, right? Um, and you just work through that. So it is 10:10. I do apologize for it being a little bit later than usual, but I appreciate all the time that you guys have spent with me this evening. For those of you who have finished work and then have to come on this webinar, I hope that you found that this webinar was super helpful and beneficial to you. And if you guys have any questions, definitely don't hesitate to reach out to me for any comments about this. And again, you can get additional note packages and PDF information from education@prepformula.com. And this is, I just kind of wanted to show you some examples tonight, and you can see sort of like what a professional who has been doing this for quite a while, what it looks like. And I think it really sets things up. At the end of the night, thank you again. I appreciate all of the time that you guys spent. Hopefully you learned a lot with me, and leave me a good review when you guys are done. Okay, have a good night, all of you. Thank you.